This is the Daily Market Rundown live from the Tradelo Trading floor. It's January the 8th and some highlights from today's show. Rising rates are causing tensions, NVIDIA sinks, and the S&P 500 is due a correction. Good day traders and welcome. There's quite a lot happening out there, quite a bit of volatility in a number of markets, so let's get stuck into it. Yesterday the theme was of course Trump. He took center stage at Mar-a-Lago. He came out, said a number of things, spoke of course about Greenland and how that was a priority for the US given security measures. He also spoke about the Suez Canal and taking that back. He then sort of got briefed on some of the more important topics, things that are important for us as market participants, with particular attention on of course tariffs. Now he didn't say anything new. What I think he did say is more of what he told us on the campaign trail, which is, look, we are going to impose these tariffs, we're going to use them as a bargaining chip, and we're going to go after what we want, and if we don't get it, we're just going to simply impose tariffs on countries, including the likes of Canada and Mexico. Now, nothing new there. Okay, we knew this. There was nothing of substance yesterday, but the reality is that the idea of tariffs is scaring markets. In particular, it is creating quite a bit of tension in the bond markets. Now, with that in mind, let's talk about some of the other key news, starting of course with what Wall Street did yesterday. It was all about NVIDIA. NVIDIA opened on the high tick, opened at effectively a double top record high, and it never ever bounced once. It didn't find any buyers all day, and it actually closed on the absolute low of the down. We'll talk a little bit more about why this matters in a moment when we talk about the S&P, but the reality is we're in that sort of a environment now where markets are quite nervous. Volatility is picking up. It's still relatively low, but volatility is picking up. So vol in particular is going to be something to watch out closely for today, as well as, of course, what NVIDIA does. Now, Wall Street, the fears are sort of twofold. One is this idea that higher rates are creating a little bit of a ripple effect. We see it again today, of course, with yields pushing higher in the back end of UK in particular, followed by the US and, of course, Germany as well. So we have this continued theme of higher yields in the back end, and it is creating quite a bit of nervousness. Now, the trigger yesterday for this, well, we had some really good data out of the US in the form of non-manufacturing data, the effectively, as well as the JOLTS number. Both of them pointed to both a strong labor force as well, of course, the prices paid part of the PMIs create a little bit of nervousness around this idea that inflation is now stuck or sticky, as well as potentially ticking higher. So that was what we were sort of given as a context moving into yesterday's session. Now, if we go and have a look at one of the key charts I want to pay attention to. If we look at yesterday, this is the Fed funds rate for DEC. In other words, this is the market sort of expectation of where rates will be come the end of this year. Now you can see, roughly speaking, as of the close of yesterday's session, the market still was pricing around one rate cut for this year. Keep in mind the Fed thinks we get two. Now, what matters in terms of this chart is not necessarily where we're trading. I think whether it's one cut or two cuts priced by the market. I think two things we want to take from this. The market now is a little bit more hawkish than the Fed, and for good reason. We are, of course, seeing inflation tick higher. But importantly, look at the reaction there. If you notice the reaction and the rejection we had, it was almost a 6-7 basis point turnaround in the DEC futures. Now, again, what does this tell us? Well, it tells us there's perhaps a little bit of reluctance from market participants to push too hawkishly at this point in time. Why? Well, we've got 8 meetings this year. We've got 12 non-farm payrolls, 12 CPI events. There's a lot of data between now and end of the year. So to sort of rule out any more rate cuts from the Fed is perhaps a little bit premature. But this is definitely one to watch. Why? Well, if we're going to break below that December low and, of course, yesterday's low, what that's telling us is that the market actually thinks that the Fed is pausing indefinitely for this year. That will, of course, just continue this idea of higher for longer, and that will have some downside impact, of course, on risk markets. Now, If we then move across, it was all about NVIDIA, like I said, open at the high, absolute closed on the low. This sort of price action, you always want to pay attention to. Why? Because it tells us there wasn't a single buyer in the market all day. And that is effectively the case if you look at any time frame, whether it's a 5-minute, a 15-minute, an hourly, you'll see there was really no interest to provide liquidity in NVIDIA. It very much just opened at the high, sold off, and closed at the low. Now, what we typically see after these types of days is a bit of a staging event. What do I mean by that? Well, look, NVIDIA sold off a lot yesterday. It was down 6.5%. We should see some form of a staging bid today. Okay, don't be surprised if this is today's open. We open a little bit, try and bid up, try and sort of see where those sellers come in. Why does this happen? Well, because realistically, everyone that needed to sell out yesterday sold out. And what did they sell out into? They sold out into a non-existent bid. Okay, and that's why we had such an oversold type event today. Does that mean we can go further today? 100% we can, but it's very likely in the high probability plays we're going to get some sort of a bid to find where that pocket of sellers exists. Okay, where that might come in is anyone's guess. I think anywhere around that 144, 143 area is a good area to watch closely. Should we find some liquidity there, don't be surprised to see NVIDIA test and perhaps extend on yesterday's low. Of interest, there are no real levels. Okay, I think the reality is that NVIDIA could drop down to 132 and still be very bullish structurally. Okay, keep a close eye on that. Why? Well, because look, if NVIDIA sinks again today, if we take out that low and we start to offer, don't be surprised for equities to continue, given not just the NVIDIA theme but also the high yield theme that is rippling through markets. Now, that in mind, I think two things to pay attention to today, tomorrow, the next day is what does the VIX do, okay? If you go and have a look, when we spiked up to 23 in mid-December, that was of course over the Fed event where they were quite hawkish. They signaled 2 cuts this year instead of 4. The VIX popped up to 23. Okay, the result was the S&P traded down. I'm going to just snap across to this. The S&P traded down to around that 58.80 level. Okay, the point is now, if I go back to that chart, yesterday we traded not yesterday, at the start of this year we traded up to 19 on the VIX, but effectively if you look at that S&P, we made a double bottom in terms of price. What does this tell us? Well, as it tells us, there's not a great deal of concern in the market. There's not really that much fear yet in the market, and from a hedging perspective, well, it's still relatively cheap to be hedging in the VIX. So what does that mean? Well, look, it means that there's every possibility that the markets do try and stage a bid from you. Okay. However, should we extend upon yesterday's high in the VIX, I suspect what's going to happen is if we do make a higher high and at the same time we break below that 5,900 in S&P, I suspect that's going to move the pricing in the VIX quite a lot higher. And the fact that the pricing will become more expensive should accelerate the sell side to the downside. Okay, what does that mean? Well, look, we break below that support level, that triple bottom, call it whatever you want. We break below that 58.80. It's going to push the VIX higher. That's going to make hedging a little bit more expensive, and we are going to see quite a few more positions look to sell into the outright market. Okay, levels, there aren't really any. I think the market has had quite a substantial rally since October 23. We are due a correction. If we go and have a look at the correction last year, where we started to see quite a bit of an economic slowdown, this was around an 8% correction. So again, I think anything, sort of in that ballpark, 5 to 10% correction from recent highs, I don't think that's necessarily crazy. What that does is it means 600 points lower from the high. So somewhere around that 5,400 is a 10% correction. Okay, that's a complete sort of thumb suck. There's no real logic behind how I've come to that level. That just is a 10% correction. Okay, the point is that the market is due this correction. We broke below the 58.80, and you're going to see that VIX pop up. You're going to see people moving into the outright market to get out of those positions. Okay, keep a close eye on it. There's a lot of action expected today. In terms of economic data, we've got a couple of secondary type data prints out, so keep an eye on that. And of course, we've got the key non-farm payrolls tomorrow. On that note, very importantly, and we'll talk a bit about this tomorrow, don't forget, non-farm payrolls has all the hallmarks to be a sell-only equities. Why? Well, good number obviously creates the concerns around higher yields. Bad number creates concerns around some form of a slowdown in the economy. So it could be a sell equities either way into non-farm payrolls tomorrow. However, we'll talk more about that tomorrow. That's it for now. If there are any other questions, do post them in the Discord private channel. Otherwise, good luck out there. Manage at risk. Go make some money.